What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. Raise the Bar family. Today we've got a heavy hitter, Tim Bratz, founder and CEO of Legacy Wealth Holdings. Tim is a multifamily operator, entrepreneur, and educator who's built his business on doing things the right way and thinking long term. Multifamily isn't broken, it's evolving, and the people who understand that are about to build the next generation of legacy portfolios. If you care about building real wealth and real legacy, you're going to want to listen to this. Tim, welcome to the show, brother.
Hey, Seth, great to be here, man. I appreciate you having me.
Yeah, brother. Can't believe we haven't brushed shoulders before at events or social media or anything like that. This is the first time we've actually chatted, so really excited to meet you and have an awesome conversation today, brother.
Likewise, man. Yeah, it's kind of wild. We're supporting a lot of the same people and on stages and all that kind of stuff. So it's awesome to finally connect.
Absolutely, man. I always like to kick it off with this, brother. When a stranger asks you what you do in the streets, what do you say? Because for us entrepreneurs, sometimes that's a little bit more of a complex question. But what's your answer to that?
Yeah, man. I just tell them I'm a real estate investor. Hey, I invest in real estate. I buy apartment buildings for my own portfolio, and then that usually leads. Wait, really? Oh my gosh, I lived in an apartment building once. Oh my god, it's like takes you down a path, and depending on who they are and what they do. I can get a little bit deeper into it. I'm not like a walking business card or anything like that, though. I just kind of, I'm very social out and about and in networking and doing the real estate stuff that, especially if I just meet somebody on the street, I just kind of, if they end up being in real estate, then I'll dive deep into it and all that stuff. But a lot of people, man, the surface level conversations are just kind of the weather type stuff. I move past pretty quickly.
Yeah, I'm sure you get it a lot because you just shared that you live in Charleston, South Carolina. I'm in San Diego, so we have the best weather. So I'm sure you get it all the time, like I do.
Yeah.
All right, brother. Tell me what you're obsessed with right now. What's on your mind as an entrepreneur? Sometimes we get pulled in a lot of different directions, but what are you obsessed with right now? What's your focus?
It's exactly the opposite of that I'm obsessing over. Is like, dude, I got pulled in so many different directions. I got pulled and started doing so many things and adding all these things to my plate that I was like, dude, I'm just spread too thin, right? I bought an island. I have my education business. I have my investment company. We have the big thing that we're working on right now is our tech software. And we have a property management software that is, 4 years in development. We have world-class a world-class dev team that we actually pulled from. One of my biggest investors was one of the top guys over at Rockwell Automation, which is a $45 billion engineering firm. And he left, grabbed 3 of the best people that he's ever worked with in software engineering, and they've been working on our software full-time for the past 3.5 years now. And so we've developed a property management software called Smart Management, and it goes toe-to-toe with Yardi and AppFolio and Rent Manager and RealPage, and it smokes all of them, dude. It's an all-in-one solution, and it's layered with all sorts of automations and artificial intelligence and all that stuff. So it's really, really good, right? I'm obviously biased, but everybody who's looked at it, everybody who's utilized it knows how antiquated our industry is in property management softwares, and knows that there's a desperate need because everything else is more expensive. This is something that empowers landlords and owners to take on ownership in-house. It will amplify great management companies, and it will expose shitty management companies. So that is really exciting because it's an industry mover that I'm obsessed with. And at the same time, dude, the upside in tech and software is like unlike anything I've ever seen. And so we are consolidating a lot, and I'm obsessing over consolidating all the stuff, right? Like just little things, man. Everything from selling my jet skis to narrowing down my education business and getting rid of all other ancillary offers and getting rid of any properties of mine that are out of state or fire selling them, and just focusing on our portfolio in the Carolinas and Ohio, which is where my team's located, and then all in on the software. So got a lot going on, but I'm trying to make it less, to answer your question.
I love that, man. I do the same thing, and I'm working on that this year. That's big on the goals list in 2026 is to, shed all the excess fat, really try to figure out what we're going to focus on this year. And it's really difficult because as entrepreneurs, we get bigger and we get more opportunities. We get presented with things that we're like, ooh, that could work, or this could work, or yeah, that's a great idea. It might be a great idea, but it's not what we're going to be working on, right? You've got to really focus to succeed on things.
And there's 100 good ideas, right? There's 1,000 good ideas, but there's only one best idea. There's only one best way that is the most fulfilling, the easiest, most lucrative, most fun, right? Path to move forward. And I heard, I think it was Morgan Housel talking about it, who's the author of, I think it's like The Art of Spending and Psychology of Money. And he was talking about, no, it was Ben Hardy. It was Dr. Benjamin Hardy who wrote 10X is better than 2X. And so he was talking about, dude, the reason people don't reach these massive goals isn't because they don't have a good path, they don't have a good vehicle, they do, they have a good, but it's an okay vehicle, right? It's good enough, it's successful enough, and it's like it's not having a great pathway, it's being acceptable to lesser paths to success, right? Being willing to take lesser paths to success keeps us in this level of mediocrity, and these less efficient paths to success, they're good enough, they pay the bills, it's one of those psychological effects where like, dude, we're not held back by reaching these massive goals because we can't figure out what that path is. We're held back by reaching these massive goals by paths of lesser efficiency and lesser effectiveness. And that's what we do, man. We say yes to all this shit all the time. And dude, my island's awesome. I have a 110-acre island in Beaufort, South Carolina. It's one of the most majestic, beautiful properties you've ever seen. And at the same time, if I turn it into an event retreat and I make, we generate $3 million a year in revenue, dude, we keep $1 million, $1.5 million of it, that doesn't change my life. You know what changes my life? Is taking a software business to $3 billion, right, that I own 25% of, call it, and having insane amounts of cash flow from it and enterprise value and shaking up an entire industry, not just me getting impacted by it. So it's stuff like that I've been really reflecting on of where do I really want to be spending my time and what's the real impact that I want to be making here.
Yeah, what did that look like for you as you started looking at all the different businesses and facets within those businesses that you might shed or you might reduce or you might cut back or you might sell? What went through your mind? Was it really a financial decision, or what kind of went into all that?
Yeah, it's twofold, right? And I did this when I was a solopreneur. After I went to my first mastermind, they're like, dude, go back, catalog your time, everything you spend your time on, every 15 minutes. And I did it for an entire week, a normal work week. And from the time I got my head out of bed to got dressed, took a shower, got cleaned up, ate breakfast, walked my dog, went to work, tooled around on social media, watched a TV show, made dinner with my wife, like whatever, I cataloged all of it. And then after a week, I went to every single line item and I either put a $ or a 0. Did it make me money or did it not make me money? And then a smiley face or a frowny face. Did it make me happy or did it not make me happy? As simple as that. And I think that's a simple exercise that we can do to reflect on every stage that we're in business and looking at all my different assets. I just went back to my personal financial statement. I was like, this one's a pain in my ass. This one makes me no money. Let's get rid of all those, right? They're out of state. We have to use third-party management because we don't have the bandwidth to take it on in-house. And That's where all the issues are. Like, I'm finding these correlations in different things, but it all comes down to, is it making me money or not? And does it make me happy or not? And dude, if it's not making me happy, I'm not at a point in life where I need to do shit that doesn't make me happy anymore. And so, I don't come from money. I have some now, but I don't need it either, and I don't need more. And what I found is after my income hit a certain level, the quality of my life didn't get any better. As I went from 1,000 doors to 5,000 doors in my rental portfolio, dude, I couldn't afford anything more than I could already afford at 1,000 doors. It just created more headaches. It created more phone calls, more conversations with investors, more loan liability, more headaches, more answering problems, more lawsuits from slip and falls and all the other stuff that comes with it. So it's like my quality of life actually got worse as I increased my door count, specifically with the types of doors that I was buying. Heavy value add, 70s, 80s vintage, which is traditionally, C to B class type properties, out of state, tertiary markets, right? That was great to get my initial portfolio built up, but it wasn't great to stay there. And I didn't need to keep on buying heavy value add stuff after I hit a certain amount of doors, and yet I still did. And I partnered with people who were shitheads, and I, didn't learn my lesson early enough in order to refine the portfolio a little bit earlier. The market was great. It was easy for 12 years, right? 13, 15 years. It was awesome. And then all of a sudden takes a dump over the past 36 months and all that stuff gets exposed. And so you start looking back at your portfolio and start thinking, what do I like doing? What do I not like doing? And the people that I look up to in real estate who own big portfolios, but also have amazing lifestyles and they're good family men and great fathers, great spouses, also with big portfolios, fun to be around, likable people. It all comes down to 5 things. They buy great properties, meaning typically they either buy them that are less than 20 years old or newer, or they build them themselves. They buy in great areas, A and B class areas, that's it. They put fixed rate, great debt in place, fixed rate, long amortization schedules, minimum 10-year terms, right, on the balloons. They in-house manage across the board, and they never sell. That's buying criteria now.
I love that. That last one that you said, that's completely opposite of what we've kind of seen towards the end of this cycle where all these syndicators got involved and, there were a lot of masterminds teaching people to do that. And they really just turned into these big flips, right? Instead of flipping a house, you were flipping an apartment building. It just turned into, let's see how quick we can renovate and sell this thing. Or the idea was to renovate, refinance, and then sell. But the market was so good and the rents were just going up so fast in certain markets that they just sold them in 2 years. And they really didn't have to operate them. They didn't have to do the rehabs very well. The market really just saved them across the board, and they would just sell these things in 2 years. How do you train investors, or your investors, I guess, to look at things differently, right? To look at these assets like the way that we got into the real estate game, which is long-term. Like, let's buy and hold these things for cash flow long-term. That's why we all got into it. But it's kind of a mindset now with a lot of passive investors that they think, ooh, I want to get into this, double my money as quick as you can, I want back out.
Yeah, I think there's so first off, dude, you need active income and you need long-term wealth. You got to have both of those things, right? And if you're not transacting deals and taking acquisition fees, dude, there's not enough cash flow from rental real estate to sustain a lifestyle. So you need some sort of active income. And that's, I know we all want to be all in on one thing or the other, and if you can, that's awesome. But I'd be thinking of something adjacent to what building wealth, right? Like, I got a buddy who has about 300 doors in Massachusetts, and he's got great equity built up in these things, but he needs some cash like right now, and he doesn't want to sell because he's got good properties, good areas that were fully renovated with great debt in place. They in-house manage them, they're easy, but they just don't spit off enough cash flow. So here's what he did. He started buying and flipping small multi, right? And so he would buy anything from a duplex up to like a 15 unit, go in there, renovate it with his existing renovation teams to keep his team busy while he's not buying big apartment buildings, keeps them busy, fix it all up. They put the tenants in place, keeps his leasing agents busy. His manager can still manage it, and then they turn around, they put those smaller buildings up on the market, and he's got pops of over $1 million of profits in the pipeline. I think he's already, collected $300,000 or something like that in the first, from the time he started doing that, which I think was 7-8 months ago. He's collected about $300,000 of transactions, and there's another $1 million in the pipeline right now that's supposed to close over the next 6 months. So, dude, that's a great ancillary business as he's building his long-term wealth and waiting for principal pay down, property appreciation, rent growth, and all those things on the 300 apartments that he has to build long-term wealth. Dude, those apartments are going to be worth $200,000 a door in a few years. He'll have them paid off free and clear. They'll be spitting off tons of cash flow. And he's got a few partners, but let's say he owns 300 units, $200,000 a piece. That's $60 million. Let's say he's got a third of it. That's $20 million net worth that he's going to have just by holding those properties and letting time do what it does. But he needs to pay the bills today, right? And so now he's got this other business that he's transacting, smaller multifamily. It amplifies his existing business because now he's getting better pricing on supplies, better pricing from vendors and contractors, and keeping his team busy, keeping them sharp, keeping them active, running ads for new tenants, placing tenants in his units, placing tenants in, right? He's doing all the things that are 1 degree away from what his expertise and his team's expertise already is. And he's able to generate an extra $1 million a year for himself by doing that. I think that's a really, really critical point as you're growing your portfolio until he's got his portfolio for a decade, right? And now he can refinance, pull out a couple $1 million tax-free, or just let it cash flow heavily because the rent growth has substantially increased. There's things like that where once you're in the business for a little bit, yeah, you could be in a pretty good shape from your rents. But in the meantime, you need something short-term. I think that's an important thing. Just, dude, don't go buy a blue-collar business if you're a real estate guy, right? What the hell do you know about that? And that's where I see people messing up. I think his idea was brilliant because it's adjacent to what he's already doing. So I think that's a critical piece of one thing to think differently about. Now, the other thing is we get in our own heads of the expectation that other people set in their real estate deals that we think we have to do the exact same thing in ours. Dude, just because somebody has a timeline of 3 to 5 years to cycle their investors' money back doesn't mean you need to have that same timeline. Dude, if you go and poll your investors, which I just did this, I have a deal that we built we bought it in 2020, built a bunch of townhomes, smoking deal, awesome property, brand new, dude, exactly what we're talking about. Great property, great area, great debt. We refinanced, but we were constrained by interest rates, which then constrained the debt service coverage, which then constrained our loan proceeds. So we had the idea that when this thing would be built, we'd be able to then refinance, get everybody their money back, and then hold on to these things long term. Well, guess what? The market changed in the middle of construction, and when we went to go refinance last year on everything, we didn't get the proceeds that we wanted. We could only get, I think 10 or 15% of the investor principal returned. And so there's 85% of their principal still tied up in this deal. I said, hey, I can sell it. We've got a lot of profit, but they're great properties, great areas, great debt. Rents are growing substantially in the area. If we hold on to this thing for another 3 to 4 years, I think we've got a way bigger payday. And we're still paying, preferred returns, a 10% preferred return. And so I sent out a survey to everybody, and I said, what do you guys want to do? Dude, 80% of the investors said, hold it. I don't need my money back in 5 years, right?
Yeah.
Hold that. We're good with a 9-year hold. As long as I keep on making my 10% annual preferred return, yeah, let's ride it out. Dude, only 20% of people said, hey, I really want to cycle the money back out. Life happens. My other business is struggling. I need the cash for whatever. I'd like to sell. And so we're looking at it from a standpoint of, one, I thought everybody was like, hell or high water, I need my money back inside, 5 years. And that's not the case, dude. Most investors are thinking the long-term game and they want that legacy wealth as well. So understand that is one thing. But also leave yourself an out, right? Leave yourself a buyout clause in your PPM or in your operating agreement that if you want to either re-syndicate, you could do that. Right now, obviously, you have to disclose and has to be a fair price and all that kind of stuff. But if you want to re-syndicate, and I have the ability to go and buy out these 20 investors at fair market value. Like we just got them all refinanced, so we have appraisals on everything, and we have a set price less what closing costs would be in commissions and all that stuff if we went to sell. So I could take the set price minus 6% or I can't remember exactly what it is, but deduct that by 6%, and then I could buy them out of their shares if I wanted to. Or I could re-syndicate and bring in new people to buy them out of those shares. So it's just leaving, and this isn't stuff that you think about on your first deal. This is stuff that you come up with as you've done deals for 5 years, 10 years, 15 years like I have.
Yeah. Dude, there's so much gold in there. It sounds like you've uncovered that it's an us problem. When I say us, I mean capital raisers, operators, the folks running the deals. We're the ones that think in our minds, man, we need to exit this thing in 2 years, 3 years, 4 years, 5 years. Yep. But really, and that's probably because of the cash flow problem you also identified for a lot of folks. When really the investors would love to stay in this long term. If they're getting consistent cash flow month after month, quarter after quarter, year after year, they'd want to stay involved. And you said you took that poll and 80% wanted to stay in that deal long term because they were getting consistent cash flow over time. That's incredible. That's incredible because in my mind, that's what real estate's about. It's long-term wealth. And when we got into those 2, 3, 4, 5 year flips, I was like, man, what is it? I mean, you just, that's why sometimes you get out of house flipping, right? Is to get into apartments and long-term stuff. And then we just turn that into, a bigger flipping game. Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. But as you also noted, that's a good way to make cash flow, right? A lot of folks over the last few years that were in the capital raising game, in the multifamily game, got washed out because they had a cash flow problem. They weren't making any money. They couldn't pay their bills. They went back and got their W-2 or whatever they were doing before raising capital and doing multifamily. So really interesting. And I think there's another opportunity with, you've got a reset of investors as well. Even though at their core, they may want those investments. Sometimes they may have been influenced by us and said, ooh, I want my money back in 2 to 5 years. A lot of those investors that were used to that aren't going to invest in multifamily right now because they got burned for whatever reason. So you've got new investors coming in and you're kind of resetting that framework and that mindset for them.
100%, man. 100%. It's and the caveat here is this deal performs, right? If I went to one of the deals where we're not paying out pref because we are cash strapped, guess what? Dude, those deals exist too. And I'm sure every one of the investors, or it will be flipped, right? 20% would say write it out. 80% would be like, dude, sell it. Let's get our money back out. Of course, right? Even if I don't catch up the preferred return or whatever that looks like. So, they want their cash back. They want to be able to recycle. So it really depends on the deal. But if it's a good deal, good area, good debt, in-house managed, where you have control over it, and you have the ability to hold it long-term, too, just go to the investors and have that conversation with them. That's where the hedge funds and private equity and stuff get tied up, and the family offices and stuff. Well, not really. Sometimes the family offices are much more patient, right? And they're cool with a 10-year or 15-year time hold on all that stuff. But a lot of the private equity groups and stuff, dude, they're going out and raising capital for their private equity fund based on a 5-year hold. And so they have to transact every certain number of years. And that has spilled over into the traditional retail investors. And so we think we got to do the same thing. We don't, right? It's actually probably more of an advantage if you are a buy and hold person because nobody else or not many other people are doing the buy and hold play right now.
Yeah. Totally. What would you tell syndicators out there right now that are kind of holding on to these properties that maybe aren't doing that well, that aren't cash flowing, but maybe they're not necessarily distressed, but there are a lot of them out there, right? I mean, what do you, any advice for those folks that are listening and trying to figure out what their next move is?
Yeah, I mean, dude, that's a great question because it's been an absolute bloodbath across the board for the past 36 months or longer. I mean, people talk about interest rates, and interest rates have been a kick in the crotch for sure. We've never seen as steep of an incline in interest rates as we have over the past few years. There's also, though, a lot of expenses that are standard expenses, but interest rates go up and down. You know what doesn't go away is insurance premiums, right? Or property taxes that get reassessed and increased over time, and energy costs that have gone up, and labor costs that have skyrocketed, and material and supply costs that are more and more expensive. Like, these are all things that are here to stay. Interest rates coming back down, dude, it doesn't impact the net income, right? It impacts the cap rate that you can sell it at, which is a big impact on the value, the enterprise value. But it doesn't matter if you're looking to hold long term, right? But if you are looking to transact, it matters in a big way. But you know what does impact, regardless of whether you're holding short term or long term, is all the expenses and how everything's gotten more expensive. And that's here to stay. And then the other thing that's evaporated more of my net worth, more of my wealth, more of my property and asset value than anything else, than all of those combined, has been horrible third-party property management and joint venture partners that don't carry their weight, dude. It's bad management has affected my net worth more than anything else over the past 36 months. And so I've had to eliminate, like, dude, we only managed 300 doors of our 3,000 door portfolio in-house before 36 months ago. Now we manage 2,100 doors in-house because I've had to fire over and over and over again third-party property management and move joint venture partners out of the way. I've had to bring more capital deals. I've sunk millions of dollars of my own cash in and had to raise more cash into different transactions. Dude, it's been a bloodbath across the board. And by the way, dude, I hit the curve of buying apartments before most people did. And I refinanced almost everything in 2020, 2021, and early 22. I only had 3 bridge loans that were all fixed rate, by the way, and only 1 variable rate loan when these rates started going like this. And so it's been tough on me, but even more so, man, I can't imagine what it's like for a lot of other people. I'm seeing properties being given back left and right by big firms, right? And big institutions and tons of mom and pop investors and a lot of the people who talk on stages and have their mastermind groups and all that kind of stuff. Dude, it's rampant out there. So first off, don't feel bad, right? This is a market type thing. It sucks and it feels like crap to go through it. And you start asking yourself and self-doubting, right? Like, oh, I should know better. I've been in this industry. I've been buying apartments personally since 2012. But it's always been a positive market, or at least a stable market, right? It wasn't easy back then, but it was at least stable. They didn't have all the variables. Like, we've gone through the past 6 years, dude, has been more variables than the past 100 years of the U.S. economy, dude. It's been insane. And so to think that anybody can navigate this properly is, I think silly and egotistical if anybody says that. So don't beat yourself up about it, right? I think the key here is having honest conversations. Honesty is always the best policy. Having honest conversations. Do you have the team and the wherewithal and the ability to bring management in-house? Because if you don't have management in-house, you have potentially bad data, potentially false, like straight false data, and everything. Dude, it's like driving, me getting the reports on the I just got a report on the 20th. We're filming this on the 21st. I got a report on the 20th of the month for last month. Dude, how the hell does anybody operate a multi-million-dollar investment without real-time financials? It's like driving a car looking in the rearview mirror, trying to drive forward, only looking backwards. How does anybody not crash? You're going to crash. That's absolutely going to happen. And if you don't have real-time transparent financials and accurate data, dude, you're done. And I can tell you every single one of those deals that we took back from third-party management, every single one of them had undisclosed age payables. Not only were they delayed financials, they were incorrect financials, and they were giving us financials that did not accurately portray all the different expenses and bills and all those kinds of things, trying to make themselves look better or hide things, or just level of incompetence. And it doesn't matter if they had good intentions and they were incompetent or they were ill-intended. Got me the same result, right? And either way, they need to go. And so I'm like on fire about how much I hate third-party property management, bad third-party property management. Good third-party property management, I love. They're just very, very hard to find. And so I would rather see owners control the controllable, right? There's a lot of things outside of our control right now. Dude, you got to take control of what you can control. And that is property management, dude. Build it out. It's a pain in the ass, but it is the lifeblood of whether or not you can actually build wealth and maintain wealth in owning rental real estate. Dude, it's not finding deals and raising money. That's the cool part. That's the sexy part. That's the fun. That's not, the work begins after you're done closing the deal. Right. The work begins in the operational side, and it doesn't end. You have to do it on an ongoing basis. So I know nobody wants to build out property management internally, but I'm telling you, it's what all the big boys do. Anybody who's been in the game long enough knows that it is a requirement that you have to have in-house property management. So you got to figure out the systems, you got to figure out the processes, put SOPs in place, put checklists in place, put contracts in place, review everything. Like, it's not easy, but it's one of those things you can just kind of gradually grow and increase. Like smart management, we actually put all of our SOPs in smart management. For anybody who doesn't have the experience that we have, they can just piggyback on our SOPs that we've learned over the past 15 years of doing rental real estate. And if they do have their own SOPs and their own systems or nuances in a certain market or whatever, they're fully customizable. So it's like, find tools and resources like that you can utilize in your business, so that way you don't have to go and learn by losing money and losing time the way that most of us have.
Yeah, totally. Property management, man, and you're right. It's not sexy, right? A lot of people will say it's not a profit center, but it's a necessity. You have to be able to bring it in-house at some point. Sometimes it's not necessarily an option for smaller operators if they just own a couple of smaller units. But it's something, as you grow and as you scale, it has to happen. What about
it's a
the
simple
market?
math equation, dude. It's like, hey, if I'm paying 10% on management fees on a bunch of single-family rentals that I own. Okay, and the average rent is $1,500 a month. Let's call it $2,000 a month. Okay, well, how many on 10% on that, on $2,000, it's $200 a month for a management fee that I'm paying on that property. Dude, it's simple math. What does it cost in order to hire a full-time property manager at $6,000 a month? Well, it's 30 properties, gets me $6,000 a month. Is what I'm paying out in management fees. I can just bring that internally, hire somebody full-time. That single person can manage 30 rentals easily. Dude, I managed 150 rentals by myself, right? The first 150 rentals that I owned with one part-time helper. And that was it. So like, you can absolutely hire somebody and then have them, and it's just a math equation based on what is the rent and what is the management fee that you're paying, figuring out how much it's going to take in order to then hire a full-time employee. And that alone will give you so much more clarity on your financials and the condition of the property, and it'll give you more structure and positioning in able to operate it properly.
Yeah. Would you be now that you've invested all over the place, but now you're trying to bring it all in-house property management in somewhat locally within the Carolinas and Ohio? Are you kind of in the school of thought now that you should invest somewhat locally or at least regionally? Or what would you advise for people that are investing maybe all over? Were they buying California? They buying Arizona? They buying North Carolina?
Now there are some states that are very, like, dude, I heard California either pass a law or is trying to pass a law that if a tenant stops paying rent and you have to go through the eviction process, the landlord has to pay for all of their legal fees. I don't know if that's the case. I don't know if that's in just certain counties or whatever, but I heard somebody talking about that, told me about that like last week.
Well, that's a totally different conversation with where you should invest, right?
Yeah.
California is probably not one of them.
So there is that, right? What I would say is there are acres of diamonds in your own backyard, right? And there's infinite potential regardless of the market you live in. even if you're in New York State or like, dude, you know the housing court, you understand the rules and regulations, you have local attorneys and CPAs and management companies and vendors and contractors and suppliers. Like, you already have all that stuff. When you go into a new market, you have to go create all of those relationships again, right? Like, there's goofy French laws in Louisiana that you're probably not aware of and no other state is aware of, right? There's certain blue states and red states, and even if you go to a red state, there's certain blue counties that are much harder to manage in. And you have to learn how to navigate all that stuff every new market you go into. And you got to get on an airplane, and you have to rent a car, and you have to rent a hotel room. And like, there's a lot of expenses when you start going wide. And I went 12 different states wide across the country in multiple markets in those 12 states. And it was brutal. Dude, it was just brutal. Like, we had to send a team out. We're spending all this money, and we're going through the learning curves of losing time and losing money. And it's just not, to me, it's not worth it. I'd rather see you be a heavy hitter in your own local market and be the person that everybody brings apartment buildings to, right? They know that you are an active buyer in Columbus, Ohio, or in Dayton, Ohio, or in Sheboygan, Wisconsin. Like, dude, it doesn't matter. Be in your own backyard, and I'd stay within, I don't know. Me personally, I try to stay within an hour of other properties that I own. Some people go 2 hours out. Some people go 45 minutes or whatever. But like, we're in Cleveland. I'm from Cleveland originally. My team's from Cleveland. Do I think Cleveland's the best market? No. There's zero appreciation in Cleveland. But there's great rent growth. But there's also all these hoops you have to jump through in certain cities before a property can transact, the city comes in and goes up through an exterior inspection, tells you all the improvements that you have to make to it. Like, there's been properties that I bought and went to go sell to flip in certain cities where they made me install a new garage, like tear down the whole garage and install a new one. It wasn't on it 6 months prior when I bought the property, but then they added it on later. Like, dude, that can wipe somebody's legs out if they're not familiar with how to navigate those systems and the nuances in these different markets. And so, understanding the market that you're in, is there diversification if you're in two different markets, right? Like, would I be in all coastal areas of the Gulf Coast? No, I wouldn't, because insurance is through the roof. The Carolinas are awesome, but they also don't have the cash flow that Cleveland, Ohio has. And so I get the cash flow in Cleveland, and I get the appreciation and rent growth in South Carolina and in Georgia, where I am. So it's like, you can kind of navigate some of these things. But I think 2 markets is more than enough. And I wouldn't go into a new market unless you're intimately familiar. Maybe you go on vacation there all the time, or maybe you have family members there, or you have like a business partner who lives there, is intimately familiar and has resources and connections and all that stuff, where it's an easy leap into that new market. It's I wouldn't just start shotgunning and doing deals all over the place. So I like the idea of just investing in your own backyard.
Yeah, plenty of opportunity nearby for sure, or at least have some sort of a relationship with where you're looking, and maybe you're really familiar with that market, or you have a business partner who is. Switching gears just a little bit, what are you seeing out there with opportunities with multifamily? What would you do right now? Maybe if you weren't kind of refining, but somebody that is trying to scale in a tough market right now, like what's the state of multifamily? Where's the opportunity? Is it going to change, or what are you thinking here?
Great question. So first off, the only reason I'm refining is because I have a software that has a $1 billion potential to it, right? Like, it's more robust and more feature heavy and way better than AppFolio. Like, smokes AppFolio. I love AppFolio. I think AppFolio is one of the better ones in the property management softwares, or I did love it until we built ours. And AppFolio is a $10 billion company, right? Like, so I know that we have a trajectory to hit multi-billions in our property management software, very predictably. So, like, the only reason I'm not buying more apartments is because I have this other opportunity in front of me that has this huge upside. Okay, if I didn't have that, I would 100% be buying apartment buildings more, right? Because what's happened over the past 3 years is a lot of the people who were dipping their toe in apartments are gone. Right, so the competition has been limited dramatically. There's more sophisticated, right? All the sophisticated people who had real businesses are still standing, but they've also grown. Like, I'm not buying value add, tertiary market apartment buildings anymore. that doesn't mean there's not smoking deals in those areas, right? Like that's actually a really good thing for somebody who does want to scale their portfolio, because you can go get it. Like I'll give you an example. I'm selling some apartment buildings I own in Albany, Georgia. And Albany, Georgia is a tertiary market, central Georgia, right? Pretty landlord friendly, very easy to rent. We have great demand there for our rentals. Good units, great management team, all that stuff. On those properties, I'm selling them for like $62,000 a door. 62 grand, dude, you couldn't build it for 2.5 times that, right? So when I look at the current landscape of the market, first off, we are 4 million housing units short in the United States right now today. Not only that, but we need another 1 million housing units a year in order to keep up with demand. And the builders have been pencils down since interest rates started skyrocketing, right? They get loans based on the short-term federal funds rate. That's how their loans are priced. And so when their prices went up for the cost of capital, they stopped banking land. They stopped buying projects. They stopped getting improvements and all that stuff. They saw what they had through to the finish line. And those deliveries happened in 23, 24, and 25. But when rates started skyrocketing in 22, they stopped buying stuff. So there's no real product or no new starts that happen in 23, 24, or 25. Definitely not for affordable housing. If there is anything, it's all luxury stuff. Because, dude, you literally can't build a house for less than $300,000 in the United States today. And you can't build an apartment, multifamily apartment, for less than, I'd call it $150 plus land cost. So $150 a door, right? $150,000 a door.
Yeah.
So like, dude, if you can buy houses for under that price point, and if you can buy apartments for under that price point, they're not being built. I think, and generally speaking, these are 70s and 80s vintage apartment complexes that are some of the best located real estate in these municipalities too, right? They're more urban centers, they're closer to downtown, they're walkable, there's shops and restaurants and all that stuff. So like, they're just dated properties. So if you can get into some of those properties, renovate them, update the mechanicals into some of these things, you'll be all in for less than $100,000 a door and be able to compete against new construction that has to price at double the rents than you do. And dude, you'll just gobble up market share. I think there's a huge opportunity for that moving forward. One, in just buying and holding and eating up market share because you have great located properties, you did the renovations, you can throw some new debt on it, and there's plenty of demand for that because over 50% of the population is affordable housing. Over 50%, right? And so that just doesn't exist, and there's never going to be built more affordable housing than what's available right now. You can't physically do it unless there's some insane government subsidies that end up happening, which who knows? Maybe they keep printing, there's something that goes on there, but who knows? Right now, dude, I think there's a huge play for buying apartment complexes under $100,000 a door. I got some groups out of New York and New Jersey that just made an offer on a property of ours in Illinois. And dude, they just came in swinging a big bat and said, hey, we're going to close in 60 days, no contingencies, we're buying it as is. Like, it's a good property in a good area, renovated, but it's an older housing stock. But dude, they're just collecting apartments at $65,000 a door. And so, dude, I think there's a big play there, one. Two, I think there's a big play in bringing rescue capital to deals that are struggling, that, hey, somebody could stay on the loan, move them out of the way, you step in a creative finance type structure, bring some new capital. It sits more senior in the capital stack to their LP equity. You make sure that you can dictate the returns that you need to get for you and your investors. Step in, boom, and you can get into a deal for 10% down as opposed to 40% down because of debt service coverage restraints right now. So I think that's a big opportunity. And then the other one that we're pursuing right now is I got a phone call actually in 2 days from now with one of the cities to do a condo conversion and talking to them about taking our apartment complex and turning it into condos. Because, dude, they have there's no housing. There's no affordable housing that they can buy, that anybody can buy in the area. Minimum house price is $250,000, and that's for a dumpy property and blah, blah, blah. So we're going to go into a couple of the cities that we own apartment buildings in, especially the ones that have like kind of a townhome style apartment. And we're saying, hey, I'd love to convert these. Right now I could sell them for $75,000 or $80,000 a door, but I could turn them around, condo convert them, and sell them for $120,000 a door. That's half of what the lowest house in the area is priced at. And somebody can now own, create stickiness for the city, right? And more adoption, and they want to see more homeowners in the municipality. And it allows me to sell my apartment complex with a lot more work and there's going to be more costs and stuff, but I could sell it for 50% more than what I could sell it to an investor for. So it's going to take a lot of deals that were losers and could take them and make them winners.
Love that. That was gold, man. I love the last one as well, where everybody's a win-win. You can make more money on it, converting them to condos and selling them, but also create home ownership for folks. And you might be able to pitch the government on that as well, because everybody's going to win in that scenario. That's awesome, brother. Hey, Tim, it's been awesome having you on the show. Where can our listeners find out more about you and your property management software? Because it sounds like that's incredible.
Yeah, appreciate it, man. Just connect with me on social media, guys, at Tim Bratz. And then our property management software is called Smart Management, smartmanagement.com. And feel free to jump on there. You can jump on the wait list. We have a pretty substantial wait list, and the first 100,000 doors that come onto our software will vest into equity in the software as well. So not only do you have a better software at a lower cost that makes management of your assets far, far easier, you'll be able to eliminate a lot of expenses, probably remove people from your payroll, which goes straight to the bottom line, which amplifies the NOI and the asset value. But even more so, you also invest into equity in smart management as a whole. So we're pretty excited about that, and kind of seeing early adopters of the software as our business partners. So if you're interested, jump on smartmanagement.com, and we'll add you to the wait list as we onboard more and more units in 2026.
Awesome, brother. Appreciate you.
Thank you for having me, Seth. Great questions, man. Great to finally connect, and hopefully we get to see each other in person sometime soon.
Absolutely. Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.